All right, welcome back to the deep dive. It is February 1st, 2026.
It is. The future is finally here. And
Oh.
I don't know, it's a lot louder than I think we all thought it would be.
It is. It really is. You know, usually on the show, we spend our time looking backward.
Uh-huh.
We break down the history of a concept, or we'll analyze some book from the 90s to see what it did, right?
See where the predictions landed?
Exactly. But today, I mean, the sources you've brought to the table are forcing us to look right at this very moment. And honestly, it's a little disorienting.
Well, it's meant to be disorienting. I think that's the point. We're living through a genuine phase shift, a real historical discontinuity.
We are, and the topic today is what the analysts are calling the Great Divergence. And our mission for this deep dive is very specific. We are trying to move past the generic, AI is cool or AI is scary headlines.
Look past that now.
We're so far past that. We're looking at the single biggest economic question that's keeping people up at night right now. And it's not, will a robot take my job? We sort of know the answer to that is complicated.
It's yes, no, and maybe all at the same time. It's not a useful question anymore.
Right. The real question, the one that's, buried in this entire stack of research is this. In a world where AI does the work and the marginal cost of intelligence, of problem solving, drops to effectively zero, where does the value go? If smarts are free, what becomes expensive?
That is the trillion-dollar question, isn't it? And if you actually look at the data we have here, I mean, you look at these charts on energy consumption, the labor supply graphs, the shifts in monetary policy, the answer is, well, it's terrifyingly clear. We're seeing a split, the divergence.
Between the things that are getting prohibitively expensive and the things that are deflating, just collapsing in price.
Exactly. And the really scary part, the part that these articles just hammer home, is that for the last 100 years, the whole middle-class deal was simple.
Right.
You rely on your salary.
Your labor.
Your labor bridges the gap. You work hard, you get that 3% raise, you buy a house, you save some money in cash. That was the social contract.
And the source material we're looking at today argues that as of 2026, that contract is null and void.
It's been torn up. It's broken. Because the fundamental input of that contract, human intelligence, human labor, is being repriced by the market. And the market is absolutely ruthless. It is repricing it downwards.
Okay, so here's the roadmap for this deep dive. We are going to take you from that pit in your stomach, that anxiety everyone feels when they see a new GPT model release. You know what I'm talking about.
Oh, I know. Well.
And we're going to turn it into a strategy. We are going to construct what the papers are calling the survival portfolio for the AI era.
And we're going to talk about why you need to own the physical world, the stuff that, hurts if you drop it on your foot.
I like that definition.
And why you need to own digital scarcity. And most importantly, why holding cash right now is, mathematically speaking, a complete disaster.
They use this phrase in the research, this analogy, and it just stuck with me. The melting ice cube.
It's this perfect visual, isn't it, for the modern bank account?
It really is. We'll get to the ice cube. But first, let's set the scene properly. It's early 2026. 2 years ago, people were still debating if AI was a bubble. Remember that?
I do. It was, it's just a chatbot. It hallucinates. It can't do real math. That was the narrative.
And now it is integrated into the operating system of everything. It's in our phones, our cars, our legal systems. We have AI agents negotiating our calendar invites.
And look, we have to start with the optimism.
Yeah.
We really do. Because if you just read the financial doom scrolling, you miss the absolute miracle of what's happening.
Yeah.
AI is the greatest deflationary force in the history of humanity.
It is.
It is driving the cost of solving problems to zero. Just think about medical diagnoses for a second.
Right. You upload an MRI scan, and an agent can analyze it better, statistically better, than a human radiologist for a fraction of a cent.
Or coding. Or education. I mean, we basically have PhD-level consultants in our pockets for $5 a month. That is a miracle for the consumer. It fundamentally raises the standard of living. If you want to learn quantum physics or write a novel or build an application, the barrier to entry has just evaporated.
It's an absolute miracle, but, and this is the but that drives this entire deep dive, markets don't care about miracles. Markets care about scarcity.
Exactly. Price is just a signal for scarcity.
Mm-hmm.
I mean, think about it. Air is vital for life. It's a miracle, right?
Mm-hmm.
We die in minutes without it. But it's abundant, so it's free. If intelligence becomes as abundant as air, you can't charge a premium for it.
And that's the paradox. Abundance is fantastic for you when you're the buyer.
Oh, it's the best.
But it is terrible for you when you are the seller. And for their entire lives, most people have been selling one thing,
Their time and their competence.
Their competence, their ability to process information and execute a task.
And the desire loop that's mentioned in the source material that really resonated with me, you, the listener, you see this abundance. You see agents writing marketing copy. You see agents handling customer service. You see agents creating entire feature films. And the immediate gut reaction is fear. It's, how do I compete with a thing that works 24/7, never sleeps, never complains, and costs pennies?
And the answer we are proposing today, based on all this research, is blunt. You don't.
You can't. It's a fool's errand. You do not compete with the machine on labor. You have to flip the script. You have to own the assets the machine needs. Or you own the assets the machine simply cannot print.
It's a fundamental shift. We're moving from an economy of laborers to an economy of investors.
Think about the Industrial Revolution, right?
Yeah.
We moved from farms to factories. And that wasn't just a change in location. It was a fundamental change in the nature of value. The muscle power of a human became less valuable than a steam engine.
It was repriced.
It was repriced. And now we're moving from doing the work to allocating the capital. If you are strictly a laborer in 2026, relying 100% on a paycheck with zero assets, you are in what these strategists are calling the kill zone.
The kill zone. That's a heavy phrase. Let's unpack the math behind that because it sounds hyperbolic, but the numbers really do back it up. Let's get into segment 1. The macro thesis, labor devaluation.
It all comes down to basic supply and demand. I mean, what happens when you flood a market with supply of anything?
The price crash.
The price crashes.
Yes.
Okay, so look at the supply of competence in the market. Basic coding,
Flooded.
copywriting,
Flooded.
data analysis, flooded. Even really complex tasks like legal discovery or paralegal work. The supply of entities, whether they're silicon or biological, that can do that work has exploded. Not by a little, by a factor of a million, maybe more.
So the wage, which is just the price of that labor, has to be suppressed. But wait, let me just challenge this for a second. We aren't seeing massive wage crashes everywhere yet, are we? We're seeing slower hiring, we are seeing big layoffs in tech, but it's not like the minimum wage just dropped to zero.
No, you're right. Wages are sticky, as economists say. They don't crash overnight. But you have to look at the real wage, the wage adjusted for inflation. And you have to look at the hiring freezes. That is the invisible crash. Companies are growing their revenue without growing their headcount. That is the divergence in action. The productivity gains are off the charts.
Right. It's the profit margin expansion. I get it.
Exactly. If a company can fire, say, 500 customer support staff and replace them with an AI agent swarm that's more effective and costs a fraction, the company makes way more money. So where does that value go?
It goes to the shareholders. It goes to the owners of the company.
It shifts from the line item wages to the line item profits, from the worker to the owner. It is a massive, and I mean massive, transfer of wealth from labor to capital.
So boil it down. If you own the stock of the company, you win. If you just work for the company, you lose.
Broadly speaking, that's the dynamic. But it gets more complicated because the government sees this happening.
They have to.
They have to.
Yeah.
Governments cannot just stand by and let 30% of the population fall out of the middle class. That leads to riots. That leads to political instability. That leads to people sharpening guillotines in the town square.
So they have to react. And this is where the monetary response that the sources talk about comes in.
Correct. And it doesn't matter what you call it. Universal basic income, stimulus checks, adjustment assistance, the label is irrelevant. The mechanism is the same. The government have to print money to bridge the gap between lost wages and the rising cost of living. They have to inject liquidity into the system so people can still buy food and pay rent.
But we've seen this movie before. We know exactly what happens when you print trillions of dollars. We saw it in the early 2020s.
You get inflation. But, and this is the crucial point, you get inflation specifically in the things that cannot be printed. This creates what the strategists call the pincer movement, the squeeze.
Okay, break that down.
So on one side, you have AI suppressing your earning power. It's putting a ceiling on your salary. That's a deflationary pressure on your wages.
Makes sense. My labor is worth less.
Right. On the other side, you have the government's money printing, which drives up the cost of scarce assets. We're talking groceries, fuel, rent, housing. That is an inflationary pressure on your living costs.
So I'm getting hit from both sides. My income is capped by the robot, and my expenses are uncapped by the printing press.
That is the squeeze. And that is why the middle, which is defined as cash savings plus a salary, is the kill zone. You are holding a melting ice cube in a high-tech oven. You have to move. You cannot stay still.
Okay, I think we have sufficiently terrified everyone listening.
Well, awareness is the first step. You can't solve a problem you don't understand.
True. So now let's move to the strategy. How do we insulate ourselves from this? The sources suggest what they call a barbell strategy. You avoid the middle, you go to the edges.
To the extremes.
Edge number 1 is physical scarcity, and edge number 2 is digital scarcity. I'm going to take the lead on the physical side because, as you know, I'm a bit of a Luddite at heart. I like things I can kick. I like things that have mass.
The floor is yours, our resident macro strategist. Tell us why rocks are suddenly so valuable in the age of algorithms.
It's simple, because the algorithm lives in a rock. That is the biggest misconception about the entire digital age. We talk about the cloud. We think of it as this ethereal, weightless mist floating in the sky.
It's just some fluffy white thing.
It's not. The cloud is a building. It's a massive concrete windowless box in Northern Virginia or the Nevada desert, and it's filled with hot silicon, screaming fans, and miles of copper wire.
And it is hungry.
It is voracious. So hard asset number 1 in our survival portfolio is energy. The data point that just jumped out at me from this report. A standard Google search, the old school kind we used to do, uses a tiny blip of power. A single query to a state-of-the-art large language model. It costs 10 times more energy. 10x.
And we're not just running one of those. We're running billions of them a day now, globally.
And that's just the chatbots. That's just us asking questions. We're now moving toward persistent agents. An agent that runs in the background for you 24/7, negotiating your schedule, booking your travel, optimizing your portfolio. That agent is burning electrons every single second of every single day.
It's a constant drain on the grid.
A constant drain. And we're scaling these models up to be thousands of times more powerful. The entire industry is chasing AGI, artificial general intelligence. This intelligence doesn't run on air. It doesn't run on hopes and dreams. It runs on electricity. It runs on physics.
This is a real physical constraint. We are actually seeing this in the real world. Data center construction is being halted in places like Ireland and Loudoun County, Virginia, because the grid literally cannot handle the load. The utility companies are showing up and saying, stop, we have no more power to give you.
Exactly. So my thesis is simple. If you believe AI is the future, you have to believe energy demand is going vertical. It is the most direct one-to-one correlation in the market. Everyone is chasing the sexy tech stocks. Everyone wants to buy the next NVIDIA or get a piece of OpenAI.
The glamorous side of it.
That's fine. That can be the growth bucket of your portfolio. But the real picks and shovels trade is the grid itself.
It's the infrastructure play. It's boring, but it's essential. You can have the smartest code in the universe, but if the power goes out, it's just static. It's nothing.
So what are we buying? The sources point to 3 specific commodities or the companies that produce them. First up, uranium.
Ah, nuclear energy.
Yes. And look, I know nuclear has had a stigma for decades, but you just have to do the math. You cannot run a massive 24/7 AI data center on solar panels alone. The sun goes down. The wind stops blowing. These data centers need what's called baseload power. They need a flat, steady, massive output all the time.
Uninterruptible.
Uninterruptible. And nuclear is the only carbon-free way to do that at the scale we're talking about.
And public sentiment has really shifted on this, hasn't it? In 2026, we're seeing a full-blown nuclear renaissance. The big tech companies, Microsoft, Amazon, Google, they're signing contracts directly for SMRs, small modular reactors. They basically want their own private nukes to power their data centers.
They have to. They can't wait for the public grid to catch up. They're taking matters into their own hands. So uranium is the fuel for the AI brain. Second commodity, copper.
Why?
The wiring of everything. You need to move all those electrons from the power plant to the data center. We are essentially rewiring the entire planet. The grid updates, the data centers themselves, the electric vehicles we're all supposed to be driving, they are all incredibly copper hungry.
So demand is just exploding.
And here's the kicker on copper. This is the really important part. It takes, on average, 15 years to permit and build a new copper mine.
15 years. So even if we decided today we need more copper and started digging,
we wouldn't see a single pound of that new supply until 2041. Geology doesn't care about your stock price. You can't just spin up a copper mine like you spin up an AWS server. The supply is hard-capped by geology and by regulation. Meanwhile, demand is going vertical. That is the literal definition of a supply squeeze.
so the price has no choice but to rise significantly to ration the available supply.
Exactly. And third, and this might be a little controversial to some of our listeners, oil and natural gas.
The fossil fuels.
Look, We all want to be green. I get it. But when push comes to shove and the AI needs power right now and the wind isn't blowing, we are going to burn natural gas. It is the ultimate backup. It's dense, it's reliable, it's there.
It fills the gaps.
It fills the gaps. And here's the beautiful asymmetry of this bet, and this is what I love about the physical thesis. Scenario A. AI is a massive, world-changing success. Energy demand goes up 50% over the next decade. Your energy stocks absolutely rip higher.
You win.
You win. Scenario B, AI turns out to be a bust. It's a bubble. It all pops. Guess what?
Humans still need to heat their homes.
Humans still need to heat their homes. We still need to drive cars. We still need the lights on. The downside is incredibly well protected. So energy is the floor of the portfolio. It wins in almost every plausible future scenario. You can print code, but you cannot print uranium. That is the bumper sticker for this entire segment.
I like that. That's a powerful statement. But energy isn't the only physical asset you're focused on. We also have to talk about where we live and what we own.
Right. Hard asset number 2. Real estate and metals. What I call the physical moat. There's that great Mark Twain quote, right? Buy land, they aren't making it anymore.
Classic.
In a world of digital abundance, where I can generate 1,000 beautiful, perfect images of a sunset in a single second, the value of a real sunset on real land that I own, it goes up. Digital abundance makes physical scarcity a luxury good.
Okay, but there's a counter-argument here. Some of the futurists I follow, some of my colleagues, would say that as we spend more and more time in VR or working remotely, the physical world starts to matter less. Why own a mansion if you can live in a custom-built palace in the metaverse?
I buy that argument to a degree. Maybe we don't need giant centralized office towers in downtown New York anymore. I think that's probably true. But at the end of the day, we're biological creatures. We're apes in shoes. We need to eat.
We do.
Which brings up farmland. Our sources consistently list farmland as a key defensive asset. It's physical food versus digital content. You cannot eat an NFT. With global supply chains getting rockier and the climate shifting, owning the source of food production is the ultimate safety net.
It's the base layer of Maslow's hierarchy.
Exactly. And regarding cities, humans crave connection. We are social animals. Even with Zoom and Hollins, the premium for being in a walkable, safe, vibrant physical community is skyrocketing. The bad real estate, the generic office towers, the decaying suburban malls, that's crashing. But the good real estate, the homes in desirable, well-run cities, is becoming untouchable.
It's a bifurcation. Not all dirt is created equal. You have to be selective.
You have to be very selective. And finally, let's talk about the oldest asset of them all, gold. Now, I know you're the tech futurist. You probably think gold is a pet rock.
I wouldn't go so far as to say Tet Rock. I respect the history. It's a Lindy asset for sure. It's been around for millennia. But it has friction. It's heavy. It's hard to transport. You can't send a gold bar over email.
It's heavy. That's the entire point. It's real. Look, gold is not an investment in the sense that it produces cash flow. It doesn't pay you a dividend. It's a store of value. It's like a battery that holds your purchasing power through time.
A monetary battery.
A monetary battery. If governments are printing money hand over fist to fund the AI transition and all the social programs that come with it, gold just floats. It acts as a raft in that sea of liquidity.
Yeah.
It is the one thing that has 5,000 years of history saying, I am money. Nothing else can claim that.
Yeah.
So my side of the portfolio is set. Energy, land, gold, the stuff you can touch, the stuff that keeps you alive and warm.
It is a solid foundation. I will absolutely give you that. You need a floor. You need that safety. But safety doesn't give you the upside. And safety doesn't protect you from the sheer speed of the digital change that's happening. Can I take the wheel and steer us into the digital lane for a bit?
Take it away. Convince me why I need invisible internet money.
Okay, so you've made a great case for physical scarcity, and I agree with 90% of it. But there are limitations, which you even pointed out.
Such as?
Gold creates friction. You try to cross an international border with $1 million in gold bars, good luck with that. You'll be stopped, you will be questioned, it might be confiscated.
Fair point.
And land is great, but it can be taxed into oblivion. Can be rezoned. The government can say, hey, we need this specific piece of land for a new high-speed rail line, and they can take it from you via eminent domain. It's fundamentally immovable, which is both a strength and a weakness.
Of vulnerability.
Of vulnerability. So in the 2026 landscape, we need an asset that is as portable as a piece of information, but as scarce as your uranium.
And you're coming back to this abundance problem again.
I am, because it's the core of the whole thing. Let's just think about the philosophy for a second. AI creates infinity. Infinite text, infinite video, infinite code, infinite solutions.
Mm.
In a world of infinity, scarcity becomes the single most valuable attribute. If I can replicate your voice, your image, and your work a million times for free, what is the one thing I absolutely cannot replicate? This is where Bitcoin enters the conversation.
The digital hedge.
You can think of it that way. Or you can think of it as the exit valve. We talked about your melting ice cube, the cash in your bank account, being debased by government printing.
Yes.
When that new liquidity floods the system, where does it go? It has to go somewhere. It chases assets that have a fixed or limited supply. You mentioned gold. But gold is not perfectly fixed.
It isn't. I thought it was pretty scarce.
It's scarce, but it's not fixed. If the price of gold goes to, say, $10,000 an ounce, what happens?
We mine more of it.
Exactly. We invent better mining technology. We dig deeper holes. We start mining the ocean floor. Maybe we even start mining asteroids. The supply reacts to the price. It's elastic.
Yeah.
It increases by about 2% per year historically.
Yeah. A higher price always triggers more supply. That's just basic economics.
But Bitcoin is the only asset in the known universe with a supply curve that is perfectly vertical, perfectly inelastic. There will only ever be 21 million, period.
Yeah.
It's hard-coded into the mathematics of the protocol.
And that can't be changed.
Not without the consensus of the entire global network, which is practically impossible. So it doesn't matter if Bitcoin goes to $100,000 or $10 million a coin. You cannot make more. The inflation rate of new Bitcoin is mathematically determined, and it gets cut in half every 4 years on a predictable schedule.
The halving.
The halving.
Okay.
So as the denominator of our equation, the supply of fiat currency like dollars, euros, yen expands towards infinity to pay for the AI transition. The numerator, the supply of Bitcoin, stays fixed at 21 million. The math itself implies that the price, when measured in those currencies, must rise over time.
So you're not seeing Bitcoin as a tech stock or some kind of crypto gamble. You're seeing it as a mathematical certainty against currency debasement.
Precisely. In 2026, we have to stop looking at Bitcoin through the lens of getting rich. That was the 2017 narrative. The new narrative is about not getting inflated away. It's a defensive mechanism. It is a monetary shield.
Okay, that makes sense.
But there is another layer here, a layer that fits perfectly with your AI thesis. Think about those AI agents we discussed earlier. In 2026, these agents are starting to transact with each other. They're paying each other for API access, for data, for storage space, for computation.
A machine-to-machine economy.
A true machine-to-machine economy. Now, do you think an autonomous AI agent is going to open a Wells Fargo bank account?
I can just picture the robot walking into a branch with a utility bill and a passport photo. I'd like to open a checking account. No, of course not. The KYC, know your customer laws, make that impossible.
Exactly. The entire traditional banking system is built on identity. It's built on trust and passports and government IDs. And AI doesn't have a passport. And AI needs a financial system that is permissionless and native to the internet.
It needs its own money.
They are going to use the native currency of the internet. They're going to use crypto rails, whether that's Bitcoin and the Lightning Network for settlement or stablecoins for transactions.
Yeah.
So you have this incredible dual pressure on digital scarcity. One, humans are fleeing currency debasement. That's the monetary premium.
Okay.
And two, machines need a native digital currency for commerce. That's the utility premium. This combination creates a massive, massive demand shock for a provably scarce digital asset.
That is a really interesting point about the AI agents. I honestly hadn't connected those dots before. If the economy itself becomes automated, then the money of that economy needs to be automated too. It needs to be programmable.
And it needs to be trustless. An AI agent doesn't know trust. It's not a human concept. It knows verification. It knows math. Bitcoin is verification through cryptography.
Yeah.
So while you are buying uranium because the AI needs electricity, I am buying Bitcoin because the AI needs a value transfer protocol and because I need protection from my own government's printing press.
It's the shield and the rail. The shield for you, the rail for the machines. Okay, let's see if we can synthesize this. Because usually in the finance world, you have the gold bugs in one corner and the crypto bros in the other, and they hate each other. They're always fighting on Twitter.
It's a pointless, endless war.
But our source material, this deep dive strategy we're building, suggests that in 2026, that fight is just stupid.
It's completely counterproductive. It's a distraction. It is tribalism, not
Mhm.
strategy. The correct answer is not gold or Bitcoin. It is gold and Bitcoin.
Mhm.
They serve different but complementary functions in the survival portfolio. Gold is your physical, tangible insurance policy. Bitcoin is your digital, sovereign insurance policy.
Okay, let's build it then. Let's build the AI hedge portfolio. This is segment 4.
Let's lay it out. We can think of it as 3 distinct buckets.
Okay, let's be specific. Bucket 1, hard assets, the physical base. This is what I was talking about. Energy stocks, so that's uranium miners, copper producers, oil and gas companies, and physical holdings like gold, silver, and productive land. What's the role of this bucket?
This is your floor. This is your safety net. If the internet goes down, if the grid fails, if the entire digital world crashes tomorrow, you still own a piece of reality. You have warmth, you have food, you have a store of value that has worked for 5,000 years. It anchors your portfolio to the earth.
Okay, I like that. The floor. Then bucket 2, digital scarcity. This is your domain. This is Bitcoin. What is its role?
This is your shield and your teleporter. It's a shield because it protects you from monetary debasement even better than gold, because its supply is absolutely fixed. And it's a teleporter because it's portable. If you need to leave a jurisdiction in a hurry, or if you need to send value across the world instantly without asking for permission, you can. It gives you sovereignty in a way that physical assets can't.
And then there's bucket 3. We haven't touched on this as much, but it's crucial. Growth. This is where you put the AI tech stocks, the NVIDIAs, the Microsofts, the hyperscalers. We aren't saying don't buy tech, are we?
No, absolutely not. You want to participate in the boom. You'd be crazy not to. This is the engine of the portfolio. You own the companies that are building the robots, the companies writing the software, the companies designing the chips.
This is where you get your upside?
This is where you get your explosive upside. But, and this is the absolute key to the whole strategy, you don't go 100% into this bucket. Because tech is notoriously volatile. It can bubble and burst. So you use the profits from the engine, from bucket 3, to buy more of the floor in bucket 1 and the shield in bucket 2.
Ah, I like that flow. It's a dynamic rebalancing strategy. So you ride the wave of the AI boom with your tech stocks.
Right.
When they have a huge run up and double in price, you take some of those chips off the table.
They trim your position.
And do you hold those profits in cash?
No, never cash.
Right, because cash is the melting ice cube.
Yeah.
You take those profits and you immediately move them into the hard assets or into Bitcoin. You are constantly cycling wealth from the abundance sector, which is tech, into the scarcity sectors, which are the real assets.
That is a winning strategy for 2026.
It creates a self-reinforcing loop.
It does. As AI grows, your tech stocks go up. As AI grows, energy demand skyrockets, so your energy stocks go up. As AI grows and displaces labor, the government prints money to fix the social contract, so your gold and Bitcoin go up. You are positioned to win in almost every direction the wind blows.
That is a beautiful thing. That feels so much better than just sitting around worrying about my 401k and hoping for the best.
It's about being anti-fragile.
Yes. Now, there is one more concept in this synthesis I want to touch on. It's not strictly a financial asset, but maybe a career asset. The research calls it the human premium.
This is a bit softer, less quantitative, but I think it's equally important for navigating the next decade. In a world where AI can write a symphony, or paint a masterpiece, or write a beautiful poem in seconds, what happens to human creativity?
A lot of people think it becomes worthless.
I think the exact opposite happens. Things that are distinctly, undeniably, verifiably human become luxury goods.
Like a handwritten letter versus an email.
Exactly. Or a live concert versus an AI-generated track, or a handcrafted wooden tablet versus a mass-produced one, or a dinner party with real friends versus a metaverse hangout. We are already seeing this trend. The word artisanal is going to be the buzzword of the late 2020s. Human-made.
A proof of human work.
A proof of human work. So if you're looking for a career hedge or a new business idea, look for things that require deep empathy, physical presence, and genuine human connection. High-end hospitality, artisanal crafts, counseling, elder care, those are things the AI cannot easily or authentically replicate. That is a form of scarcity, too.
Human scarcity. I love that framing. The human touch becomes the premium tier of every service. Okay, so we've built the portfolio, but we also need to explicitly state the anti-portfolio. What are we actively avoiding? We've beaten the cash horse to death. What else?
Standard long-duration government bonds. For decades, the 60-40 portfolio, 60% stocks, 40% bonds, was the gold standard of safety for retirees.
It was the default advice.
In an environment of high inflation and persistent monetary debasement, long-term bonds are incredibly dangerous. A bond is just a promise to be paid back in a currency at a future date. If the government is printing 10% more of that currency every year, and your bond only pays you 4%,
You're losing 6% of your purchasing power every single year. Guaranteed.
they are, to quote a famous investor, certificates of confiscation.
That is a harsh term, but it's accurate in this context.
Yeah.
Okay, so avoid long-term bonds. Avoid excess cash. And I would add, avoid middleman businesses that AI is about to completely disrupt. If your entire business model is just moving data from spreadsheet A to spreadsheet B, you are in serious trouble.
That's the danger zone. High friction, low creativity information work. You need to get out of that business immediately.
Okay, let's wrap this up. We've covered a tremendous amount of ground. The world of 2026 is a world of divergence. The cost of smarts is going to zero.
And the cost of stuff is going to the moon.
If you stand in the middle, you get crushed.
You have to pick a side. Or actually, as we've argued, you have to pick both sides. Own the energy that powers the intelligence. Own the scarcity that the intelligence cannot forge. And use the volatile growth of the tech boom to fund it all.
It's empowering, really, when you think about it that way. Instead of feeling like a victim of the robot revolution, you become a beneficiary of it. You become the owner of the robot's food supply and the robot's bank account.
That is the entire goal. We want to move you from the passenger seat of this change into the driver's seat. The transition is inevitable. The great divergence is happening right now, whether you like it or not. The only variable is how you position yourself relative to it.
So here's the final thought for you to chew on today. We always like to leave you with something provocative to think about. We've talked about assets, we've talked about money, but let's zoom out and think about the societal structure this creates. If AI does all the productive work, and the cost of living drops for digital goods, but rises for physical assets, are we moving toward a world of technological feudalism, where there are essentially only two classes: the lords who own the servers, the land, the energy, and the scarce digital money, and the serfs, who just subsist on a universal basic income, consuming infinite digital content in a rented pod?
It's a dark thought, but it's a plausible one. And the real question that follows is, are you the lord or are you the serf? And the answer to that question depends entirely on what you buy today. It depends on whether you treat your income as something to spend or something to convert into real assets.
That's the call to action. Don't save. Invest. Your labor is the melting ice cube. Your assets are the freezer. Get out of the heat.
Could have said it better myself. And for everyone listening, please check the show notes for the charts we mentioned, especially the energy consumption data and the labor supply graphs. They are truly eye-opening.
And as always, thanks for diving deep with us. We'll see you next time.